Welcome to the adrenaline-filled world of IPOs, initial public offerings. Now, let me ask you something. Do you know what an IPO really is? Most people think it's just a way for a company to sell shares to the public. But here's the truth. An IPO is a once-in-a-lifetime event for a company, and sometimes a life-changing opportunity for investors. Think about it. Infosys listed in 1993 at just 95 rupees a share. If you had invested just 10,000 rupees in that IPO, today you'd be sitting on crores of rupees. On the other hand, Paytm, one of the most hyped IPOs of our generation, listed in 2021 at 2,150 rupees, but crashed nearly 70% afterwards. Imagine the pain of those investors who thought they were buying the next big thing. So here's the golden question. How do you know whether an IPO is the next Infosys or the next Paytm? So stay tuned and watch this video till the end to get the answer to your question. Let's say you started a chai stall. Business is booming, the aroma is legendary, even foreign tourists are asking for extra masala. But to open 500 more stalls across India, you need crores of rupees. Your savings, gone. Loans, banks are already avoiding your calls. So you do what big companies do, you sell a small piece of your business to the public. This is called IPO. An IPO is like calling the entire neighborhood to invest in your kitchen for a small piece of ownership. A company raises money from public through an IPO for various reasons like, number one is raising capital. For a fast-growing business, speed is everything. Let's say you are the owner of an electric vehicle company. You have demand, but you can't scale production without huge upfront costs. IPO capital can help you set up factories, hire talent, and expand globally before competitors catch up. With an IPO, your capital problems disappear. Number two is brand prestige. An unlisted private company may be profitable, but the minute you get listed on the Bombay Stock Exchange or the National Stock Exchange, you suddenly became known to crores of investors in the Indian stock market. Number three is liquidity for founders. IPOs give founders a chance to cash out a part of their holdings. Venture capital investors who've been holding shares in the company for 7 to 10 years, IPOs provide them with a liquidity event, the ability to exit partially or fully and lock in some profits. Now, I shall give you some practical tips for investors to invest smartly in an IPO. Whether you're a first-timer or have done it before, don't just rely on YouTube videos or stock tips. Read the RHP on SEBI or the company's website. Focus on company's business model and competitive edge, risks and challenges, financial performance, revenue, profits, debt, use of IPO proceeds, growth versus debt repayment, promoter shareholding post-IPO. Look at PE ratio, PB ratio, and EV/EBITDA compared to listed peers. If the IPO is priced much higher than competitors without clear growth prospects, be cautious. Sometimes great companies can still be overpriced. If the gray market price is higher than the issue price, the shares are said to be trading at a premium. It happens when the demand for the IPO shares is higher than the supply. It indicates the presence of more buyers in the market. Investors should check the BSE/NSE subscription data in real time. If there is high qualified institutional buyer subscription, then it is a strong signal. Investors should apply in an IPO through the correct category. Retail investors can apply for up to rupees 2 lakhs in the retail quota. Consider applying through multiple family member accounts to improve allotment chances. If you're eligible, HNI or employee quota may have higher chances of allotment. Investors should decide their approach before investing in an IPO. If you decide to sell immediately after listing to pocket quick profits, then focus on oversubscription, strong gray market premium, buzz and hype. On the other hand, if your aim is to hold the IPO stock for years, then you should look for company fundamentals, scalability, competitive advantage, promoter quality and governance, etc.